Madan, point taken. Let's also welcome Abneesh Roy to the panel. Abneesh will come to you, but before that, Mahesh, I want to ask you about this particular event now. Ever since Prime Minister Narendra Modi announced about GST reforms, there is a lot of build up to this event. We have seen many news flows after that after the two rate structure will be there. There will be ease of doing business. There will be benefit to certain sectors. But as a process, after this September 3 and September 4 meet, how does this work out? I'm sure whatever the expectation is there, even if that is fulfilled, when will this be applicable?
Thank you. I think Madan covered aspects relating to the consumer. For starters, I'm excited as well because this is going to boost sales, and the economy is going to be getting a push. We talked about the government, we talked about consumer, but I'm going to talk about the third stakeholder, which is the businesses. So businesses are looking at the first question that you raised, Ankur. How soon can this happen? Technically, once the constitutional body of the GST Council announces the revised rate structure, it could technically come in a day or two later. But I, for one, think that there will be at least some time frame that's given for companies to be prepared to be able to move into the new rate structure. One. Two, we do have the upcoming festival season from Navratri starting from September 22nd onwards. And therefore, if I was a betting guy with a quarter end also coming in, I would be hoping that we have an announcement which is slightly before we get into the festive mode. So that's one part. I think the second part, which is somewhere linked to the rate going live, is a bit of nervousness from businesses, and they're optimistic because the GST Council has from time to time issued a lot of friendly measures in terms of actually giving this benefit in totality. It heavily depends on how well the inverted duty rate formula is worked upon. So in a nutshell, if a product moves from 12 to 5, we all expect a product that's 100 rupees with 12 rupee tax to become, say, 105 very well. But the business may continue to buy inputs at a higher rate of 18 or in some cases even higher. I think business is looking at the rate, the date for the revised rate as point one, but they're very eagerly and anxiously looking at how the inverted duty, provisions will apply for stock in trade as well as for an ongoing basis where they manufacture a lower rate product. I can cover that and elaborate that as well.
I appreciate that point, and we'll get back to you on just that. Let's also get into conversation with Abneesh Roy, who's joining us to help us decode the impact of this entire rationalization exercise on the consumption front. Abneesh, hi, and thanks so much for your time today. And I want to get your sense on just that, right? Because the festive season is round the corner. You have a big boost coming in for staples. But while all looks good on that front, Abneesh, what's your sense on categories like tobacco, cigarettes? You have aerated drinks that have now been positioned to move to that higher 40% slab under that sin goods category. What could the demand approach be now for sin goods, and how does this shape up the entire balance between staples and discretionary spending?
Yes, we see this as one more positive for the broader FMCG consumption. So we have already seen multiple things pan out on the positive side last few quarters. So we have seen rural demand recover. We have seen monsoon this time being on the right side. We have also seen tax rebates by the union government earlier, and we have seen food inflation at a low. Now this step which will be announced this week, we do see that the lower end of the consumption and the mid end of consumption will see a benefit. Coming to a specific question on the sin goods, now there are two parts. One is on the cigarettes. We see more of a bucket reclassification. So currently there is a 28% GST, and then there is a cess, and there are more taxes. What we see is 28% obviously moves to 40%, and then the cess gets reclassified under another name. Overall, we see largely status quo, or maybe slight increase can happen. On the aerated drinks, again, it's a 28% plus 12%, so it's already at 40% overall. So we don't see any significant change there. So net, except these one or two segments where maybe a status quo will be there. Lot of other FMCG, especially Bikaji, 70% of the business at 12%, Imami 60% at 12%, Dabur 24%, Nestle 25 to 27%. These could be the beneficiary. And if the soaps, detergent, etc., they also get classified, toothpaste gets classified as essentials and they get taxed at 5%, then Hindustan Unilever, Colgate also will benefit. But currently those are at 18%. So we'll need to see whether that actually happens.
All right, Mr. Madan Sabnavis, talking about economics of this GST announcements, one side is definitely saying that after these announcements will be made, government will have to make up for this revenue, and therefore questions are raised whether or not there will be fiscal prudence, which are the areas where government will look into. How government may balance this out, because on one hand GST announcements are made, we are already reeling in under pressure due to tariffs announcements. So how do you think government will strike the balance?
See, I'm quite sure the government has already worked out the maths behind it, and therefore they're aware of the fact that in the next 6 months, if at all we are having this kind of a major reform in terms of reduction of GST rates, there will be a certain impact in terms of revenue. But we should remember that there have been certain other positive developments on the revenue side. Like, for example, if you look at the transfer from the Reserve Bank of India was much larger than what was expected. And there's also been some inherent buoyancy, which we have seen in other tax collections so far this year. So the government will be having these calculations ready. So therefore, I think contrary to the nervousness which was expressed by the market, I think that the fiscal deficit of 4.4% is sacrosanct. It is something which is going to be achieved. And therefore, I really don't see any major challenge as far as the fiscal balances are concerned. As far as the states will also go, I think while there could be certain shortfalls in terms of GST collections for the second half of the year, we should also remember that states are more committed to the fiscal deficit ratios because they're not supposed to go beyond the 3 or 3.5% numbers which are there. And normally this could mean that they will have to probably cut down, prune certain other kind of expenditures in case other revenue does not increase commensurately. So I'm sure there will be a good balancing act which is done by the government, which I think is fairly reasonable to expect from the government, because when you have a big reform like GST coming through, it's but natural that there will be adjustments which have to be made to the budget. But at the end of the day, if the center and the states are able to move around that particular number which has been targeted for the year, I don't really see any major issue in terms of maintaining the deficits as well as not coming in the way of economic growth.
Okay, and before we wrap up this conversation, Mr. Jai Singh, just want to get your sense on if these slabs actually play out the way the street is expecting them to. How much in line or how much closer would that bring us to what the global practices are when it comes to some countries who have adopted GST? Because I also do remember when GST was first brought into practice, we drew a lot of inspiration from the tax slabs of Canada and France. So are we heading in the right direction, or what is the global benchmark over here?
Yes, I think as Madan initially mentioned as well, from our GST at 8 survey at Deloitte, 40% participants asked for rate rationalization, and that's remained the number one policy ask. It's interesting that even when we map out the global best practices, the number one point is about rate rationalization. So with this straight answer, will it get completely close to the global? Yes, it will get closer, but not fully there. But I think we're getting much there because many countries just have a revenue neutral rate and an exemption. I, for one, believe an exemption is very dangerous because what that does is that impacts your credit chain. And most countries even have a sin good rate. So the 5% rate is slightly unique in that sense, but it's the right thing given where we are in this journey. And the actual benefit getting passed on to the common man is heavily dependent on a 5% rate where the credit chain exists. So that's my response for you, Sneha. And I'm repeating at the cost of repetition that we are not discussing too much because that's a post-GST Council aspect or a very technical aspect on one breath. But the inverted duty rate formula, which is also called out in the press release after the Honorable Prime Minister's speech, that there is some focus that's going to be there. I think when that comes in totality, we'll see alignment not only on the rate front with the global the VAT laws, but also on how the VAT and working capital benefit gets accrued to the supply chain, which could be large or MSME.
Right. Avnish, I want to come to you. If these announcements are made, and particularly about FMCG companies, what should companies do? Will they be passing on these prices, or will they improve the margins? How should corporate India expect them to behave?
No, I think once the cuts happen, the anti-profiteering clause should come back. I don't think that will be an option. Companies will have to pass it on. In the lower unit packs of 2 rupee, 5 rupee, 10 rupee, generally the grammage, obviously the grammage increase will happen. So from 12%, if it moves to 5%, 7% kind of grammage increase will happen. And on bigger packs of say price point, say above 20, it will be a price cut. So I don't think companies will have the option to really retain margins. Yes, because of the operating leverage, overall profitability could increase. That's a function of the business. But I don't think there will be a the anti-profiteering clause will come back, and companies will also look at the competitive nature of FMCG. So even if the anti-profiteering clause is not there, let us just assume, which I don't think is there. Even then, because of the competitive dynamics, I think companies will have to pass it to the end customer.
So at least looking good from the consumer point of view. But on that note, we'll wrap up this conversation and slip into a very short break. So Mahesh, Madan as well as Abneesh, thank you so much for your time. When we return on the other side, we'll take a look at the GST impact on the